So number 9, the DIY bookkeeping, or I call it getting bad advice. When you're an entrepreneur, everybody's trying to give you advice and you're asking for a lot of advice. You're seeking out a good team. Really find yourself a good team to surround yourself with, people that are that have your best interest at heart, and they're not just trying to sell you something. So a lot of entrepreneurs, for whatever reason, just say, I own the business, I can write off whatever I want. And I'm not sure where they're getting that information, but maybe they see other entrepreneurs or people before them just writing off all kinds of crazy stuff. And the tax laws are pretty black and white about what you can and can't write off. And so you need to make sure that the advice you're getting is correct. You can't just go through the drive-through at McDonald's and get your, Diet Coke in the afternoon, your dollar Diet Coke, like I do in the afternoon. And you can't just write that off on your taxes, because your business, because you were working. It doesn't work that way. The IRS doesn't pay for your trip through the drive-through or just to go have breakfast, lunch, and supper because you're working. Working meals, we'll talk about that in part 2, have a very distinguished things that they need to meet before they qualify to be expensed off. So you can't write off your living room furniture just because you work from home. So, and a lot of people will just wait till the end of the year and say, I'll worry about it later. I'll be calling my clients, please, can we get your information? And they're like, I'll just wait till the end of the year. Well, our goal and philosophy, and yours should be too, is you need to know what your business is doing day to day, week to week, month to month. And how will you know that if you wait till the end of the year and then just have this mass data input, panicky, like April 14th, trying to get everything in? Not a good way to keep your books. So QuickBooks has a great tool that automatically imports everything from the bank, and it's all in there. It comes in every day automatically. Your job is just to put it in the proper chart of accounts. So they do make it easy for you to keep it up to date and not wait till the end of the year. Because what happens at the end of the year is you're looking through your credit card receipts or just your credit card, and you're like, I don't know what I bought in Walmart a year ago. I don't know what I bought at Amazon. You can't remember. So it's harder to keep your books proper when you aren't keeping them up to date all the time. And I'll hear people say, well, the details don't matter. Look, I just went to I ate over here dinner at so-and-so, and it doesn't matter who I ate with, or I don't have my receipt. It does matter. Just because it's on the credit card, Steve Areno's at the credit card, it doesn't mean that was a business dinner. You have to have a receipt, and the details do matter. And then there are these things called GAAP rules, and that's generally accepted accounting principles right here. Generally accepted accounting principles. And those are the principles that all the accountants have to abide by, and bookkeepers. And so you need to abide by them too. And sometimes they can feel stifling, and they can feel like, well, that's crazy. I don't want to go by that. But those are the rules that we try to teach our clients as well. Hey, you just can't do that. Or, hey, this is a way to sort of get around that. So, but what you don't know about bookkeeping could cost you in a big way, because there could be some deductions that you're not taking. I'll often see clients forget to put their cell phone on there because maybe their cell phone is with their family plan, and there is a way to deduct some of your cell phone expenses as well. So yeah, so you will need to get with somebody to help make sure that you're writing off the things you need to write off, but not writing off things like going through the drive-through, or you bought a new suit, and just because you're a banker or even a lawyer, a suit is not, you can't write that off. There's nothing about that you can write off. So another thing we see clients doing is wasting too much time trying to fix things in QuickBooks. So after they get everything in there, their mistake is they get it in there and they're like, well, this invoice isn't right, or this person paid and this invoice doesn't look paid. I don't know what to do with it. And they just delete the invoice, So there's some things that they'll do that make it actually worse. So sometimes your bookkeeping isn't right, but you're not sure how to fix it. So time is money. And if you can spend your time doing what you do best, increasing your sales, meeting your clients, you're trying to find where your clients are and increase your sales, that's what you need to be doing, and not worrying about all the tedious, time-consuming bookkeeping. You can leave that to us and the professionals. We see a lot of issues with undeposited funds in QuickBooks. People just don't understand what that's used for. We see them creating duplicate income, and that means you're overpaying your taxes. So you should not do journal entries in QuickBooks. The way QuickBooks works is it's transactional. There's really very little reason to do journal entries, except the end of the year, your CPA might have you do some journal entries for depreciation, or maybe to correct some things, or maybe to pull some things out of QuickBooks that maybe weren't deductible. So you never journal out of undeposited funds, AP, AR, or retained earnings. And AP is just accounts payable, and AR is just accounts receivable. You can't journal things out of them without making a huge mess. All right, number 8, moving on, misclassifying workers. So businesses often have a combination of both. You'll have employees, but you'll also hire some 1099 workers, and they may just be temporary, they may be seasonal, or they may actually do work for you. And in some cases, you may even have some people volunteering for you, and you need to make sure that it's very clear what the person's roles are, and that they are clear that they're either a W-2 employee, which means you have payroll, you have to pay a payroll service to do payroll. You have to pay your part of the payroll taxes. And so sometimes that's a little bit much to bite off. Or if they're an independent contractor, which is a W-9, that you would give them the W-9 form. And at the end of the year, you would send them a 1099 if you paid them more than $600 in that calendar year. So there are a lot of rules about their IRS rules, and then there's state rules. And in Tennessee, the Tennessee Department of Labor governs those rules. Who qualifies for a 1099 and who qualifies for a W-2. So sometimes you have to go with the more stricter rule if it's in your state or if it's with the IRS. But in the IRS's eyes, like, everybody's an employee until you kind of prove me otherwise. But it's very important that you do get W-9s from your contractors. That's sort of your safe haven. It does tell the contractor that, hey, I'm not paying workers' comp on you. I'm not paying your taxes. You're not kind of part of the team. You don't have benefits or things like that. So you would want to make sure that they sign that document so they don't come back later on and say, hey, I thought I was an employee. I got hurt. I want to file a workers' comp claim. And you could have, some issues there. So this is just a little screenshot of some different ways to categorize employees or independent contractors. And you're welcome to take a quick screen grip of that if you like. So an employee is working for somebody else's business. An independent contractor runs their own business, and you hire them to come do something, usually on a temporary or short-term basis. It could be long-term, but it's going to be a small part of their business, like somebody that does landscaping, or me. You hire me as a bookkeeper. I don't work for you solely. I work for lots of people. So you want to make sure you understand the difference between independent contractors and employees.